There is a seductive lie that Wall Street loves to tell you. It is a lie that gets repeated in newspapers, on cable news, and in the quarterly reports of the world's largest banks. The lie is this: this time is different. They tell you that technology has changed the rules. They tell you that central banks have mastered the art of the soft landing. They tell you that we have evolved past the crude boom and bust cycles of the 20th century. But as an economist who has spent a lifetime studying the machinery of the global financial system, I can tell you that this is mathematically and behaviorally impossible. Markets are composed of human beings, and human nature does not change. Fear, greed, and the delusion of easy money are constant constants. If you look back at the last 100 years of financial history, from the Great Depression of 1929 to Black Monday in 1987, the dot-com bubble of 2000, and the Great Financial Crisis of 2008-2, do not see random, chaotic events. You see a script. You see a recurring architecture of collapse. It is not a similar pattern. It is the same pattern. It is a specific 5-stage sequence that plays out with frightening precision. It appears months, sometimes years, before the headlines declare a crisis. Wall Street algorithms are programmed to detect it. The Federal Reserve creates models to monitor it. The billionaires managing family offices are positioning for it right now. But you aren't supposed to know it exists. The system relies on you not knowing, because if the general public understood this sequence, the liquidity required for the smart money to exit the market would evaporate. Today, we are going to dismantle the complex jargon of economics and look at the raw mechanics of a crash. We are going to walk through the Babson sequence, named after the man who famously predicted the 1929 crash when everyone else was celebrating. I am going to walk you through all 5 stages: the credit explosion, the concentration trap, the smart money exit, the liquidity illusion, and finally, the trigger. And, perhaps most importantly, we are going to look at the data from late 2024 and 2025 to see exactly where we stand on this timeline today. Spoiler alert, we are much further along than you think. Let's go back to September 5, 1929. A man named Roger Babson stands before a business conference in Massachusetts. Babson wasn't a mystic. He was a statistician. While the world was drunk on the roaring 20s, buying stocks with borrowed money, Babson looked at the data. He stood at the podium and delivered a warning that made him the most hated man in finance. He said, "Sooner or later, a crash is coming, and it may be terrific." The audience laughed. The newspapers mocked him. Irving Fisher, the most celebrated economist of his era, man with a PhD, a man with tenure, a man the public trusted, publicly humiliated Babson, Fisher declared that stock prices have reached what looks like a permanently high plateau. 47 days later, the floor fell out. The market collapsed. Irving Fisher lost his entire fortune and his reputation, dying in poverty. Roger Babson made a fortune and founded a college that still stands today. Why did they see 2 different worlds? Because Fisher was looking at prices, which are emotional. Babson was looking at structure, which is mathematical. Babson had identified what we now call trigger vulnerabilities. He understood that a crash isn't an event, it's a process, and that process always begins with stage 1. Stage 1, the credit explosion. Every major financial disaster in history begins here. It does not start with greed. Greed is a symptom. It starts with debt. You have to understand the role of credit in an economy. Credit is essentially a mechanism that allows us to pull consumption forward. When you borrow money to buy a house, a car, or a stock today, you are consuming something now that you promised to pay for with future labor. In a healthy economy, credit grows in line with productivity. If we make more goods, we can borrow a little more money. But in stage 1, credit decouples from reality. We enter a phase of financialization where the economy stops growing based on production and starts growing based on leverage. In the late 1920s, this manifested as margin debt. Ordinary people, factory workers, teachers, shoeshine boys discovered they could put down 10% of the cash and borrow 90% to buy stocks. It felt like magic. If the stock went up 10%, you doubled your money. This created a feedback loop. Borrowing drove prices up. Higher prices made people feel wealthy, and that perceived wealth made them comfortable borrowing even more. By 1929, total margin debt in the U.S. equaled the entire federal budget. In 2008, the instrument changed, but the mechanism remained the same. It wasn't stocks, it was housing. Banks created exotic instruments. mortgage-backed securities that allowed people with no income and no assets to borrow hundreds of thousands of dollars. That leverage was hidden inside the banking system, sold off to pension funds as safe investments. So, where are we today? If you look at official margin debt numbers, Wall Street will tell you things look manageable. They'll say margin debt is around $750 billion, down from its peaks, but this is a statistical lie. It's a sleight of hand. In the modern economy, the real leverage has moved into the shadows. We call it shadow banking and private credit. We are seeing an explosion in securities-based lending. This is where the ultra-wealthy don't sell their stocks to buy things. They borrow against their portfolios. This creates hundreds of billions in hidden leverage that doesn't show up on standard charts. Then, consider the options market. Today, volumes in short-term options trading bets that expire in less than 24 hours have exploded. This allows retail traders and hedge funds to control massive amounts of stock with tiny amounts of capital. It is leverage in disguise, and we cannot ignore the sovereign elephant in the room. Government debt. The U.S. national debt has crossed $34 trillion. We are adding $1 trillion of debt every few months. The interest payments alone on that debt are now larger than the entire U.S. defense budget. When you combine corporate debt, which sits at over $10 trillion, with government debt and shadow banking leverage, the total debt-to-GDP ratio of the American economy is higher than it was in 1929. It is higher than it was in 2008. We have built a skyscraper on a foundation of IOUs. Stage 1 isn't just flashing red, it is blazing. We have successfully pulled decades of future consumption into the present, and eventually the future arrives. Stage 2, the concentration trap. Once the system is saturated with debt, it naturally evolves into Stage 2. This is something they rarely teach in Business 101, but it is the silent killer of portfolios: concentration. There is a misconception that crashes happen because everything is expensive. That's rarely true. Crashes happen because the structure of the market becomes fragile. In a healthy bull market, you have broad participation. Small caps, large caps, industrial stocks, utility stocks, and tech stocks all rise together. It's like a choir singing in harmony. But as a cycle ages, as the debt gets heavier, fewer and fewer companies can keep up the pace. Investors, desperate for returns but sensing risk, crowd into the sure things. They pile into the biggest, most successful, invincible companies. In 1929, it was RCA Radio Corporation of America. It was the high-tech stock of its day. It went from under $2 to over $500. Investors didn't understand the technology, but they knew it was the future. The entire market's psychology hinged on that one stock. When RCA cracked, the market shattered. In 1970, it was the nifty 50-50 stocks that you could supposedly buy and hold forever. In 2000, it was the dot-com giants: Cisco, Intel, Microsoft. The NASDAQ wasn't a market. It was a bet on 10 companies. And today, we are witnessing the most concentrated stock market in history. We have the Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. At various points in the last year, these 7 companies alone accounted for more than 30% of the S&P 500's total value. Think about the absurdity of that. There are 500 companies in the index, but 7 of them dictate the direction of your retirement account. This concentration creates a terrifying mechanical problem due to passive investing. Over the last 20 years, trillions of dollars have flowed into passive index funds like SPY or VOO. These funds don't think, they just buy. When you put $100 into an S&P 500 fund, roughly $30 of that goes directly into those top 7 stocks. This pushes their prices up, which makes them a larger part of the index, which means the next dollar buys even more of them. It is a momentum machine. It works beautifully on the way up. But nobody asks what happens when the machine goes into reverse. If Nvidia or Apple misses an earnings report, or if they face a regulatory crackdown and their stock drops, the index drops. When the index drops, passive funds are forced to sell. And what do they sell the most of? The biggest holdings. The momentum machine becomes a doom loop. We are currently seeing valuations on these top companies that demand perfection. They are priced not for good earnings, but for flawless, exponential growth forever. Any disappointment, any crack in the narrative of artificial intelligence or consumer growth, and the concentration trap snaps shut. Stage 3. The smart money exit. While the public is mesmerized by the rising prices of those concentrated stocks, something much more sinister happens in the background. This is Stage 3. This is the stage that makes me the angriest because it reveals the predatory nature of the financial ecosystem. This is the transfer of risk from the insiders to the outsiders. Before every major crash, there is a distinct period usually lasting 6 to 12 months where institutional investors, family offices, and corporate executives quietly liquidate their positions. They do not hold press conferences to announce they are selling. In fact, they usually do the opposite. They go on CNBC and tell you that fundamentals are strong. They tell you to stay the course. They urge you to buy the dip. Why? Because they need someone to sell to. If a billionaire wants to sell $500 million worth of stock, he cannot just dump it all at once. That would crash the price. He needs a steady stream of buyers. He needs liquidity. That liquidity comes from retail investors, from your 401k, from your Robinhood account. You are the exit strategy. History proves this over and over. In the summer of 1929, months before the crash, the Rockefellers and the Morgans were selling. Joseph Kennedy famously exited the market completely because he said, "Only a fool holds out for the top dollar." In 2007, while executives at Countrywide and Lehman Brothers were publicly telling investors that the subprime mortgage market was contained, they were aggressively dumping their personal stock holdings. Goldman Sachs was famously betting against the very mortgage products they were selling to their clients. Now, let's look at the data for late 2024 and 2025. We are seeing a ratio of insider selling to insider buying that is statistically extreme. CEOs, CFOs, and board members, the people who have real-time access to their company's sales data, are not buying their own stocks. They are selling. They are exercising options and liquidating immediately. At the same time, we have seen record inflows from retail investors. The average person is piling in, driven by the fear of missing out, FOMO, on the AI boom, while the people who run the companies are cashing out. This divergence, insiders selling while retail buys, is the classic signature of a market top. It is the distribution phase. The smart money has realized that the credit cycle, Stage 1, is exhausted, and the market structure, Stage 2, is fragile. So they are handing the bag to you. Stage 4. The liquidity illusion. This brings us to the most deceptive phase. Stage 4. This is the Wile E. Coyote moment where the coyote has run off the cliff, but he hasn't looked down yet, so he doesn't fall. In Stage 4, the market looks calm on the surface. Prices might even be drifting higher. Volatility is low. But underneath the surface, the plumbing of the financial system is drying up. We need to define liquidity. Liquidity is not the same as wealth. Wealth is the value of your assets. Liquidity is the ability to convert those assets into cash without moving the price. Liquidity is the oxygen of the market. In 2024 and 2025, we are witnessing a massive coordinated drain of global liquidity. The Federal Reserve and other central banks have been engaged in quantitative tightening, QT. They are shrinking their balance sheets. For years, they printed money to buy bonds, forcing cash into the system. Now, they are letting those bonds roll off, effectively destroying that money. They are pulling hundreds of billions of dollars out of the economy. Furthermore, bank lending is contracting. After the regional banking scares of 2023, member Silicon Valley Bank, banks have become terrified. They are tightening their lending standards. It is harder to get a small business loan, a commercial real estate loan, or a mortgage than it was 2 years ago. So why hasn't the market crashed yet? Because of a temporary facility called the reverse repo market and other emergency backstops the government set up. These acted like a spare gas tank, keeping the car running even though the main tank was empty. But that spare tank is almost dry. We are seeing cracks in the Treasury market, the most important market in the world. There have been days where trading in U.S. government bonds has become illiquid, meaning it's hard to find a buyer. This is terrifying. If the U.S. Treasury market sneezes, the global economy catches pneumonia. Stage 4 is characterized by this divergence. Stock prices stay high, but the money supporting them is vanishing. It creates a condition where the market becomes incredibly brittle. A small sell order, which would normally be absorbed easily, can suddenly cause a massive gap down in price because there are no buyers beneath the surface. The soft landing narrative you hear on the news. That is the hallmark of Stage 4. In 2000 and 2007, the consensus view was also a soft landing. It is the story we tell ourselves to justify staying invested when the liquidity tide is going out. Stage 5, the trigger. And finally, we arrive at Stage 5, the trigger. This is the part everyone obsesses over, but it is actually the least important part to understand. Why? Because you cannot predict it. The trigger is the random spark that ignites the fuel accumulated in stages 1 through 4. If you have a pile of dry wood soaked in gasoline, that's the debt and concentration. And you are standing in a room with no oxygen, that's the liquidity crisis. All it takes is one match. Investors always try to guess what the match will be. In 1929, it was the Hatchery case, a relatively minor fraud scandal in London involving a man named Clarence Hatchery. It caused British banks to pull capital out of New York. It seemed irrelevant to Americans. But it was the butterfly that caused the hurricane. In 2008, it was the failure of Lehman Brothers. But honestly, if Lehman had been saved, it would have been Merrill Lynch or Egg a week later. The system was already dead. It just hadn't fallen over yet. So, what could the trigger be this time? We are entering a period of geopolitical chaos. A supply chain shock in the Red Sea, an escalation in Taiwan, a miscalculation in Eastern Europe. Any of these could cause a sudden spike in oil prices or a freeze in cross-border lending. It could be financial. We are watching the slow-motion collapse of commercial real estate. Office towers in major cities are selling for 50% or 60% off their previous values. The regional banks hold this debt. If a major regional bank fails, it could trigger a run on the system. It could be the yen carry trade unwinding in Japan. It could be a sovereign debt crisis in Europe. Or it could be something totally banal. A failed treasury auction where the US government tries to sell debt and nobody shows up to buy it. The specific trigger does not matter. What matters is that the conditions for collapse are present. We are walking on a frozen lake that is getting thinner with every step. Liquidity, carrying a backpack full of rocks, debt, while holding hands with everyone else, so if one person falls, we all fall. Concentration. Now the conclusion, the choice. So, here we are. We have walked through the Babson sequence. Credit explosion. We have record global debt and hidden leverage. Concentration trap. We have a market propped up by a tiny handful of stocks. Smart money exit. Insiders are selling at a historic pace. Liquidity illusion. Central banks are draining the money supply while the plumbing shows stress. The trigger. A world rife with geopolitical and structural powder kegs. Now, I know what some of you are thinking. This sounds like doom-mongering. Markets always recover. I should just close my eyes and wait. And yes, markets do recover, eventually. But eventually is a very long time if you are living through it. It took 25 years for the market to recover its inflation-adjusted value after 1929. The Nasdaq took 15 years to break even after the 2000 crash. If you are 45 or 50 years old, do you have 15 years to wait just to get back to zero? The difference between Roger Babson and Irving Fisher wasn't intelligence, it was arrogance. Fisher believed the old rules didn't apply. Babson respected the pattern. Babson didn't panic, he prepared, he held cash. He bought hard assets like farmland, he reduced his debt. When the crash came, he wasn't a victim, he was a buyer. He bought the highest quality assets in the world for pennies on the dollar because he had the liquidity when no one else did. I am not telling you to sell everything and build a bunker. That is fear. I am telling you to look at your financial life with the cold, hard eyes of a historian. Ask yourself, are you leveraged? Do you own 500 companies? Or do you really just own 7? Are you following the smart money? Or are you providing their exit liquidity? The signs are there. The pattern is repeating. The sequence is nearing its final act. The only variable left in this equation is you. Will you be the person who says, "Nobody warned me"? Or will you be the person who saw the storm coming and prepared the ship? History doesn't repeat itself, but it rhymes. And right now, the rhyme is getting deafening. Thanks for watching. If you want to understand specifically how to track these liquidity indicators yourself, make sure you subscribe, because in the next video, we are going to dive deep into the Federal Reserve's balance sheet and show you exactly what to look for. Stay safe, stay educated, and don't get trapped in the illusion.